Welcome back to the Deep Dive. Today, we're cracking open a policy announcement that, honestly, it reads less like a typical trade move and more like a massive shockwave hitting the global healthcare system.
It really does. You're talking about President Trump's announcement, September 25th, 2025.
Yeah, and the key thing effective, just days later, October 1st, a staggering 100% tariff on all branded or patented pharmaceutical imports.
That speed is, I think, what catches everyone off guard. October 1st. It's almost instantaneous in policy terms.
Okay, let's unpack this because that speed, it makes it electrifying, but also, potentially really dangerous. Why go so extreme so fast?
Well, the framing is pure America first, isn't it?
Classic. The idea seems to be making it so painful, so unbelievably costly that foreign drug makers basically get an ultimatum.
Shift your high-value manufacturing, your complex supply chains, bring them onto U.S. soil. Or else.
It's a huge gamble, right?
Yeah.
Maximum leverage, shock reshoring, all aimed at achieving pharmaceutical sovereignty.
And what's really fascinating, as you said, is the sheer velocity. Announcing it on the 25th, effective October 1st, that gives these massive global companies, 5 or 6 days?
Basically, zero viable time to adjust operations that span the globe. No time to stockpile, renegotiate contracts, even really communicate down the chain to U.S. distributors.
Our sources are definitely highlighting this, calling it maybe the highest risk economic gamble we've seen in decades.
So for this deep dive, we really need to focus on 3 core questions that jump out immediately.
Okay. First, I think, has to be the immediate risks. What does this mean? Potentially life-altering risks for U.S. patients and for the healthcare system itself.
Right. Then second, who wins and who loses? Corporately, financially, because this policy seems to create an instant geographical split. Winners here, losers over there.
Absolutely. And finally, the ripple effects, the geopolitical side, especially for key partners. You mentioned India.
The pharmacy of the world.
Huh?
That relationship is crucial. How does this hit them?
Before we dive deeper, though, we absolutely have to stress that key distinction, the exemption.
Crucial point. Generics are explicitly exempt from this tariff. That dictates everything that follows.
It does. But the tariff hits the most profitable part of the industry, the highest value, the most sensitive stuff, patented and branded drugs.
So your low-cost generic pain reliever, your basic blood pressure med, probably okay for now.
Probably. But if you rely on specialized treatments, cutting-edge therapies, biologics, those are overwhelmingly branded. And that's where you face potentially existential costs overnight.
It targets the profit engine, essentially.
That's the core of it. Branded drugs fuel most future R&D globally. So by hitting them, the administration is aiming right at the foreign company's bottom line in the U.S.
Forcing a choice. Lose access to the massive U.S. market or make these huge multi-billion-dollar investments to reshore production.
Exactly. Produce here or you effectively can't sell here.
Okay, let's drill down into the mechanism itself. How is this structured to cause maximum disruption and, I guess, theoretically maximum incentive to reshore?
Well, you use the term shock therapy, and that's really what it is. It's engineered to create an almost irresistible incentive by literally doubling the cost of these imports overnight.
Announced September 25th, effective October 1st. That abruptness is key. No time to adjust logistics, production models, nothing.
Imagine a container ship arriving October 2nd with patented cancer drugs. Boom. The import cost just doubled the moment it hits the U.S. port.
It functions like a textbook trade war strategy, doesn't it? A massive stick and a pretty valuable carrot.
Definitely. The stick is that 100% tariff. If you're a foreign firm and you don't comply, the landed cost of your patented drugs doubles instantly.
Which, for many of these companies, the U.S. market is, 40% or more of their global revenue?
Easily. Sometimes more for specific high-value drugs. Doubling that cost essentially prices them out of the market almost immediately. No company can just absorb a 100% hit on its most profitable products.
Okay, but the stick only really forces change if the carrot is tempting enough to justify, billions in new investment. What's the path to exemption? How do companies get out from under the tariff?
The carrot is the reshoring commitment. Companies that formally commit and demonstrate that commitment to building substantial production facilities in the U.S. will be exempted.
And substantial means what exactly? Not just putting drugs in bottles, right?
Right. It has to involve fundamental manufacturing, ideally making the active pharmaceutical ingredients, APIs themselves, or doing complex formulation biologics production, real high-value stuff.
So it's an explicit ultimatum. Build it here or you can't really sell it here anymore.
The goal is to make the cost of not building here so prohibitively high that building an American factory actually becomes the cheaper, or at least the safer, long-term bet.
And the administration's justification for this, I mean, it's clearly going to cause immense pain, is framed around vulnerability, national security.
That's the argument. They're drawing directly on the COVID-19 experience, saying this reduces America's dangerous dependence on foreign suppliers.
We all remember the scramble for PPE, certain drugs.
Exactly. The pandemic revealed just how fragile those global supply chains can be. The argument is that relying on foreign powers, especially potential rivals, for life-saving medicine is a strategic liability, like relying on foreign oil, basically.
It's about securing the domestic supply chain, creating U.S. jobs in a sector deemed critical.
That's the political high ground they're aiming for, framing it as a national security imperative.
Can you give us the hard data that backs up that framing?
Yeah.
Because to really grasp the policy's severity, you need to understand the level of dependence we're talking about.
Absolutely. And the numbers are pretty stark. They do lend some weight to the argument. Currently, the U.S. imports nearly 80% of its active pharmaceutical ingredients, APIs.
80%. And APIs are the core component, right? The actual drug substance.
Precisely. It's the chemical that provides the therapeutic effect. Without the API, you have no medicine. So 80% imported means in a crisis, a geopolitical flare-up, even just a factory shut down abroad, our ability to make drugs in the U.S. is immediately at risk.
And where are these APIs mostly coming from?
When you trace it back, the supply chain narrows fast. India and China together account for over half of that critical API supply, more than half.
Wow.
And then look at finished drugs. Similar picture, especially for generics. Around 40% of generic drugs sold in the U.S. are actually produced in India.
So that reliance is seen as a major strategic vulnerability.
Yes. The administration is essentially treating pharma dependence like dependence on foreign rare earth minerals or advanced chips. They believe only a radical intervention, like this tariff, can force a change in such a deeply globalized industry.
So the logic is,
Yeah.
the reliance is an unacceptable weakness. Therefore, this radical, painful shock is necessary to force the industry to untangle its supply webs and reshore, whatever the short-term disruption. It's a price of security.
It's framed as a necessary corrective, yes. But, and this is the crucial point we need to get into next, medicine isn't like lumber or steel.
Right.
The precision required, the long regulatory timelines, the fact that patient demand is inelastic. It makes pharma uniquely volatile for this kind of shock therapy. When the supply chain for medicine breaks, the consequences are measured in lives, not just dollars.
And this is where the policy immediately runs into this huge contradiction, potentially a political nightmare. The administration has talked so much about slashing drug costs, claims of reductions up to 1,500%.
Huge promises on lowering costs.
Yet this 100% tariff seems poised to do the exact opposite, especially for the most vulnerable patients. Raising prices, possibly exponentially, certainly in the short and medium term.
That contradiction is just impossible to ignore. For anyone relying on an imported branded drug, the impact could be catastrophic. We're talking seniors, low-income families, people with very specific treatments.
Cancer, diabetes, rare diseases, complex autoimmune conditions.
Yeah. They could easily face price hikes of 2 to 3 times what they pay now. Think about it. A drug costs the importer $10,000. The tariff adds another $10,000. That's $20,000 before it even gets into the distribution chain.
And then you add distributor markups, insurance layers, pharmacy fees.
That initial $10,000 drug could easily hit the patient at $25,000, maybe $30,000 overnight.
And we already know affordability is a massive issue. See the stats. 30% of Americans already skipping prescriptions before this because of cost.
Exactly. 30% already reporting skipping doses, splitting pills, just not filling scripts. If you double or triple prices from that baseline, you're pushing the affordability crisis into genuinely lethal territory. Mass noncompliance with critical therapies becomes a real possibility.
Let's break down who gets hit hardest. What does this mean for the biggest group of drug consumers? Seniors on Medicare.
Okay, 65 million Americans are on Medicare. Many rely heavily on branded or specialty drugs for chronic conditions, heart disease, specific cancers, etc. They get drugs through Medicare Part D.
Which is administered by private insurers.
Right. And those insurers are now facing vastly higher costs to buy these imported branded drugs. They simply cannot absorb a 100% cost increase indefinitely.
So what do they do?
Their response will be swift and predictable. They'll almost certainly raise monthly premiums for Part D plans, they'll narrow their formularies, the list of drugs they cover, and they'll likely increase patient copays and deductibles.
Basically passing the entire cost of the tariff straight on to seniors and ultimately the taxpayer.
Pretty much.
Explain narrowing a formulary for people less familiar with insurance speak. How does that hit a patient on a specific branded drug?
Okay, a formulary is like a tiered menu of covered drugs. Narrowing it means an insurer might move your essential branded drug from a low copay tier, say $50 a month, to a much higher non-preferred tier costing hundreds.
Or just remove it entirely.
Or remove it entirely, which forces the patient to either switch to a potentially less effective alternative, assuming one exists, or pay the full, now doubled or tripled, astronomical cost out of pocket.
And if you're stable on a specific patented drug for a chronic condition, being forced to switch or pay 3x, the price is just devastating.
Absolutely. It undermines years of treatment stability for potentially millions of people.
What about those really vulnerable groups? Patients with rare or orphan diseases, often very small patient populations, very high-cost drugs.
This is probably the most acute risk area. These drugs are almost always branded imports, often from specialized European biotech firms. They're essential, often life-sustaining, and usually have no substitutes.
So if a treatment costs, say, $200,000 a year now,
The 100% tariff could instantly push that to $400,000 per patient per year. Even with good insurance, families might hit annual or lifetime caps faster. Deductibles, copays become simply insurmountable.
making the therapy effectively out of reach.
It forces this just cruel choice between financial ruin and survival for many of these families.
Can you give specific examples of drug categories we know are vulnerable? You hear about insulin all the time.
Insulin is a perfect example. Many leading insulin analogs, the long-acting ones, come from major European companies. Novo Nordisk in Denmark is a huge supplier.
And insulin affordability is already a massive political issue.
Front page news. Doubling the import costs of these proprietary insulins could wipe out any progress made from recent state cost caps or federal negotiation efforts instantly.
What else? Cancer treatments.
Complex cancer immunotherapies, the cutting-edge biologics. Many rely on incredibly complex, delicate global supply chains, often starting in Europe or Japan. Doubled import costs mean delays in access or doubled out-of-pocket costs for new oncology drugs. That puts immense pressure on cancer centers and patients.
Moving beyond the individual patient, what does this kind of price shock do to hospitals, to healthcare providers?
It creates enormous systemic strain. Large hospital systems, especially those with big oncology departments, organ transplant programs, specialized ICUs, they depend on a steady supply of specific branded drugs.
Their procurement costs are going to skyrocket.
Overnight. And this is especially dangerous for community hospitals, particularly rural ones. Many already operate on razor-thin margins.
Right.
If their drug budget suddenly balloons by tens of millions annually because of this tariff, it's an immediate threat to their survival. It could drive them into deficit, force consolidation with larger systems, or worse, force them to cut essential services.
We're hearing rural hospital leaders use terms like
An existential threat, and they don't mean it lightly. It reflects their immediate financial vulnerability to these doubled costs.
and even for middle-class families with employer insurance who maybe aren't using these super expensive specialty drugs themselves, the cost still hits them, doesn't it?
Oh, absolutely. The insurance ripple effect is unavoidable. The high cost of branded drugs gets spread across the entire insured pool. Insurers can't just eat a 100% cost increase on their most expensive line items.
So they pass it on.
They pass it on to employers through higher premiums. Employers then pass it to employees via higher premiums, narrower networks or formularies, and definitely higher annual copays and deductibles. The whole system absorbs the shock, and it lands on families' budgets.
Okay, the administration's counter, of course, is that this pain is temporary, the system adapts, we reshore production. But let's do the reality check. How long does it actually take to build a new pharmaceutical plant?
And that is the fundamental, probably unresolvable conflict in this policy. You can slap on a tariff today, you cannot speed up physics, chemistry, and FDA regulations tomorrow.
Right.
New pharma plants, especially the complex ones for biologics that make these high-value branded drugs, they take 2 to 5 years, minimum, just to build, validate, get rigorous FDA approval, and become fully operational.
2 to 5 years. And the cost.
Staggering. We're not talking about a small factory. A single new biologics plant or a specialized API facility can cost $2 billion to $3 billion easily.
$2 to $3 billion for one plant.
Yes. And analysts estimate that reshoring even half of the current imported branded drug manufacturing, that would require something like $25 billion to $30 billion in total new capital investment across the industry.
Plus, finding the people to run these plants.
Exactly. You need a highly trained, specialized U.S. workforce that, frankly, doesn't exist in those numbers right now. You'd need massive training programs.
So the timeline just doesn't match the immediate need.
Not even close. There was a quote from an oncologist that really hit home for me. You can't tell a cancer patient to wait 2 years for a U.S. plant to come online because we needed to secure national supply.
That puts it in brutal perspective. You're trading immediate, potentially life-threatening affordability problems for a security gain that won't even start to materialize for years.
It's a massively deferred benefit purchased with an immediate critical cost. The bet is that the pain forces the industry to move heaven and earth to speed things up.
But the FDA, its mandate is safety, not trade policy speed. You can't just bypass that.
You absolutely cannot and shouldn't want to. That regulatory oversight is critical for patient safety.
Okay, let's talk about the markets. The second this announcement dropped, global financial markets reacted instantly. And it wasn't uniform. It created this immediate, stark geographic divergence.
Polarized is the right word. It wasn't just a ripple. It was like the market split into two camps right away.
Winners and losers based purely on geography, it seems.
Let's look at the winners first. Domestically, in the U.S., U.S. pharma giants saw their stocks tick up noticeably.
Why? Simple logic.
Pretty much. This policy instantly handicaps or eliminates their main foreign competitors inside the huge U.S. market. Foreign firms face a 100% cost penalty. U.S. firms don't.
So investors see a competitive advantage.
Exactly. Eli Lilly up 2% intraday, Pfizer up 1.5%. The market anticipates they'll gain market share and have more pricing power because of this protective tariff shield.
A short-term boost for American shareholders then. Did that positive sentiment extend beyond the big players?
It did. You saw domestic biotech companies, smaller specialty manufacturers also rally. They're reading the tea leaves, seeing this tariff as a sign the administration is serious about sovereignty.
And anticipating what comes next.
Incentives. They're likely betting on something like the CHPS Act model, massive subsidies, grants, tax breaks to actually fund the building of these new U.S. plants. So speculative money flows into U.S.-based innovation and manufacturing capacity, hoping for future government support.
Okay, now let's flip the coin. The losers. Because the pain internationally, especially in Europe, seemed pretty acute.
Oh, heavily concentrated in Europe. Major European pharma firms are incredibly reliant on the U.S. market. For some, it's their single biggest source of revenue, especially for those high-margin branded drugs.
So companies like?
Swiss giants Novartis and Roche, Francis Sanofi, they all saw significant drops, 3% to 5%, right after the news broke. Analysts immediately started downgrading their U.S. revenue forecasts.
And the broader European healthcare sector.
The Eurostoxx healthcare index dropped 2.1% overall. It reflected this widespread fear about losing access or facing prohibitive costs in the world's largest drug market.
What about Asia, India specifically? We know generics are exempt, but there was still an impact.
Yes. Even with the generic shield, India's pharma sector felt the pressure, particularly on companies with branded assets. Sun Pharma slipped 2.5%. They face potential annual losses estimated up to $1.2 billion just from their patented drugs sold in the U.S.
So even partial exposure hurts.
It sends a signal. The market sees this policy as creating an unprecedented cost barrier to U.S. market access for any global exporter with branded products.
This whole situation creates a really interesting, almost contradictory investment paradox, doesn't it?
Sure.
The market's trying to process these opposing forces.
It's the definition of policy-driven volatility. Short-term, the tariff boosts domestic U.S. firms by kneecapping foreign rivals. That explains the immediate U.S. stock rally.
But the long term?
The long-term risk is huge. What if there's massive political backlash? If patients genuinely suffer? If premiums for 65 million seniors skyrocket? Does that create profound instability?
Investors have to ask. Will the administration be forced to backtrack, suspend the tariff, modify it?
Exactly. That uncertainty makes committing billions to building a new U.S. plant, a multi-year project, far riskier than investors like. They crave certainty, predictability. Shock tariffs deliver the opposite.
And let's circle back to that capital number, $25 to $30 billion needed for reshoring. How does that massive figure change how analysts value these companies?
It forces major valuation resets. Foreign firms now face this immediate dilemma. Do we spend billions building U.S. plants to keep market access, potentially at lower margins? Or do we pull back, seed the U.S. market for branded drugs, and focus R&D and manufacturing elsewhere, Europe, Asia?
And what about the U.S. firms who are supposed to be the winners?
Their valuations might rise short term, but they now face the pressure of actually executing on that $25–30 billion capital need. That drains cash flow, takes years, and carries execution risk. Analysts generally prefer the clearer path offered by subsidies, like the Cheap PS Act, where the government shares the risk.
So subsidies feel safer than punitive tariffs driving investment.
Much safer from an investment perspective. Tariffs are immediate pain. Building factories takes a long, uncertain time.
Okay, let's shift focus fully to the geopolitical side, specifically India. We call it the pharmacy of the world for a reason. They export something like $10 to $12 billion worth of pharma to the U.S. every year.
A huge volume.
The initial reaction was summed up as safe but not unscathed. Why are they considered mostly safe from this specific tariff?
It comes back to that crucial exemption, the generic shield. This is the key point for India. Somewhere between 80% and 90% of India's pharma exports to the U.S. are generics. Low-cost, off-patent drugs, and those are explicitly exempt.
So companies focus purely on generics.
Firms like Cipla, Lupin, they were largely insulated from the immediate market shock. Some generics players even saw small stock bumps.
Why a bump?
The thinking is, if branded drugs suddenly become 2 or 3 times more expensive or unavailable, U.S. demand might shift even more heavily towards the cheaper available Indian generics.
Okay, so if most of their trade is protected, where's the vulnerability? Where does India feel the pain from this tariff?
The pain is concentrated in those Indian firms that have successfully moved up the value chain, the ones investing in and developing their own higher-margin branded drugs, specialty generics, or patented formulations for the U.S. market. That's the segment the tariff hits.
So how big's the hit overall?
The sector estimates suggest an overall EPS earnings per share downside of maybe 8% to 10%. That translates to an industry-wide revenue loss of somewhere between $1.3 and $1.7 billion annually. Painful, yes, but not devastating for the entire Indian economy.
Which companies feel it most?
Companies like Dr. Reddy's Laboratories have some branded exposure. They'll feel margin pressure. But the biggest potential casualty among Indian firms seems to be Sun Pharma. They have a significant portfolio of patented drugs targeting the U.S., and estimates suggest they could lose up to $1.2 billion in annual branded sales.
Now, this tariff doesn't happen in a vacuum. It lands right in the middle of an already pretty complicated, sometimes strained U.S.-India trade relationship. What are the other friction points this adds to?
Yeah, the relationship is complex. Strategically, cooperation on security, especially balancing China, is quite high. But economically, there's persistent tension.
Like what?
Well, Washington already slapped 50% duties on some Indian exports things. The U.S. links to India continuing to buy large amounts of discounted Russian oil. That's a direct economic hit tied to India's energy policy.
And the recent H-1B visa fee increase.
That's another big one. The $100,000 H-1B visa fee has really rattled India's huge IT and tech sector. It feels like a barrier targeting a key services export and the flow of specialized talent.
A trade barrier disguised as immigration policy, some argue.
That's how it's often perceived in India. It signals Washington is willing to use various economic levers, even against allies, to achieve its goals or raise revenue. Plus, there's ongoing U.S. pressure on India to cut back its Russian oil imports, which are now around 40% of India's total oil needs, and buy more expensive U.S. energy instead.
So this pharma tariff just piles on another layer of economic pressure onto a key partner.
Exactly. It complicates things significantly.
What does this mean for the bigger geopolitical picture? The U.S. wants India as a key partner against China in the Indo-Pacific. How does this tariff play into that?
The timing is awkward, to say the least, especially with the important Quad Summit, U.S., India, Japan, Australia scheduled for later in 2025. This move risks seriously undercutting Quad unity. From New Delhi's perspective, it could look like Washington is hitting them with punitive economic measures while simultaneously demanding greater geopolitical alignment against Beijing. It creates this difficult paradox. We need your help against our main rival, but we're also going to use trade weapons that hurt your economy.
Yeah.
It undermines trust and complicates the very cooperation the U.S. wants.
Given these pressures, what are India's options? Do they just have to swallow the hit to Sun Pharma and others? Or Can they push back?
Right now, the official line from India is cautious optimism. They're stressing dialogue with U.S. trade officials, but, and this is important, they have absolutely not ruled out retaliatory tariffs.
I've done it before, right?
Yes. During the 2019 U.S. steel and aluminum tariff dispute, India quickly retaliated with tariffs on U.S. agricultural goods, almonds, walnuts, apples, things that hit politically sensitive areas in the U.S.
Oh, they have leverage.
They do. They could impose retaliatory tariffs again. Or, more subtly, they could accelerate efforts to diversify their own supply chains, maybe sourcing more APIs from non-U.S. aligned countries.
What's their biggest weapon, though?
Probably regulatory, especially if the U.S. ever tried to expand these tariffs towards generics or APIs where India dominates. India could potentially create regulatory hurdles or tweak intellectual property rules in ways that make life difficult for American pharma companies trying to sell into India or rely on Indian manufacturing. The U.S. needs those Indian generics. 40% of the U.S. supply comes from there. That's significant leverage.
Okay, let's pull the lens back and look at the bigger picture here. This 100% tariff is clearly meant as shock therapy. Double the costs overnight, creating irresistible pressure to change behavior. But this kind of aggressive protectionism isn't exactly new. What can history tell us about these kinds of moves?
The historical parallels are definitely there, and honestly, they offer mostly cautionary tales. Think back to President George W. Bush's 2002 steel tariffs.
I remember those. Lower tariffs than this, though.
Significantly lower, yes. They were imposed to protect U.S. steel jobs, and while they might have helped the steel sector slightly, maybe in the very short term,
There was a downside.
a big one. Estimates suggest they led to about 200,000 job losses in downstream industries.
Downstream meaning.
Industries that use steel as a major input. Car makers, construction companies, appliance manufacturers, heavy machinery builders. Their costs went up because of the tariff, making their products less competitive against imports. That led directly to layoffs and even factory closures in those sectors.
And didn't those tariffs get challenged internationally?
They did. They were ruled illegal by the World Trade Organization, WTO, which authorized significant retaliation from trading partners like the EU. The Bush administration eventually withdrew them under that pressure. The political goal might have been briefly met, but the broader economic damage was substantial.
Then we have President Trump's own previous tariffs.
The 2018 steel and aluminum tariffs. Similar story, really. They provided some benefit to U.S. primary metal producers, but they immediately raised costs for countless manufacturers across the U.S., and they triggered swift retaliation from allies, the EU, Canada, Mexico, hitting U.S. agriculture and consumer goods hard.
So the lesson seems to be, tariffs give you short-term leverage, maybe protect one specific sector, but they almost always hurt downstream consumers and businesses, and they invite costly retaliation.
That's the consistent pattern. But here's the crucial difference with pharmaceuticals.
The downstream consumer isn't a car company buying steel.
It's a patient, a person who needs specific, often life-saving medication. That's the fundamental distinction that makes this tariff exponentially riskier than tariffs on steel or aluminum.
Because demand for medicine is.
Inelastic. It's non-negotiable. It's time-sensitive. Unlike steel, where maybe a construction project gets delayed, or a consumer puts off buying a new car, or chooses a foreign one, a patient cannot delay their cancer treatment. They can't skip their insulin injection.
That just radically increases the political and human cost of using tariffs as your reshoring tool.
Absolutely. The administration is essentially wagering the health and finances of millions of patients against the goal of achieving domestic manufacturing capacity years down the road.
Given that immediate, obvious risk to patients, critics are arguing pretty forcefully that there were better ways to achieve pharmaceutical sovereignty, ways that didn't involve potentially harming patients like this. What were those alternatives?
The main one you hear from almost every analyst is the GPS Act model. Instead of the punitive 100% tariff stick, use the carrot. Use massive subsidies, tax credits, direct financial incentives to attract pharma manufacturing to the U.S.
A more cooperative approach?
Far more cooperative. Consensus-driven. The government essentially shares the enormous financial risk of building these multi-billion-dollar plants and navigating the complex regulatory approvals.
Why is that model seen as inherently better for something like pharma R&D and manufacturing compared to tariffs?
Because R&D and long-term capital investment thrive on predictability, stability. Tariffs create punitive volatility uncertainty. Subsidies, like those in the GPS Act for semiconductor fabs, create reliable financial support and shared risk.
Companies can plan better.
Exactly. They could better predict their return on investment, manage the huge costs and timelines. For pharma, you could imagine similar public-private partnerships investing jointly in API production, complex vaccine capacity, or even just strategically beefing up the strategic national stockpile of critical, irreplaceable imported drugs.
So achieve resilience without triggering an immediate price crisis for patients.
That's the argument. These alternatives build capacity and security without causing that immediate, potentially life-altering price shock for the most vulnerable people.
Okay, let's wrap up with the politics of this. It's undeniably a bold move. It plays directly to the protectionist base. But what's the political calculation? Why take such a massive risk, specifically with the healthcare costs of suburban voters, seniors, key demographics?
Well, for the administration, the tariff is a powerful symbol. It reinforces that America First brand very strongly. It looks like decisive action against what they frame as globalist cartels. And it delivers a big promise to manufacturing-focused voters, looking ahead to 2028 potentially. It projects an image of strong leadership securing the nation's vital supplies.
But the downside risk seems enormous and unique to this policy.
It is. Suburban voters, senior voters, these are critical swing groups. And they are precisely the people who feel drug costs most acutely. They rely heavily on the branded medications, often through Medicare Part D, that this tariff hits hardest.
So if their premiums spike or they're out of pocket for cancer drugs, doubles.
The political backlash could be incredibly intense and very fast. Opponents are already hammering the contradiction, right? Accusing the administration of raising prices on cancer patients just to score political points.
So the ultimate political gamble is,
can the abstract promise of long-term national security and reshoring possibly outweigh the immediate, tangible, painful reality of potentially unaffordable medicine for millions? The political sting of a $30,000 annual drug bill might just prove much stronger than the political appeal of a new factory that might open 5 years from now. Hashtag outro.
okay, we have covered a lot of ground in this deep dive. We've seen this 100% tariff is, well, an incredibly bold, disruptive, maybe even desperate move. It's aimed at sovereignty, at national resilience, forcing global drug makers to pour billions into U.S. manufacturing.
But the immediate cost, the price tag that you just can't ignore, is being shouldered by the most vulnerable patients, people who rely on these specific branded imports now facing potential price hikes of 200%, 300% overnight.
It really forces this central high-stakes question about economic nationalism, doesn't it?
It absolutely does. Can tariffs actually force reshoring fast enough? Can you get those new plants built, validated, FDA approved in that critical 2 to 5 year window? Fast enough to offset the immediate human cost of doubling or tripling prices on essential, life-saving medicines right now.
Because if patients start skipping critical doses, if people can't afford their treatments, the political pressure, the human suffering, could become unbearable very quickly.
Which could force a sudden, damaging reversal of the policy itself, undermining the entire reshoring goal.
You know, the market seems to be treating pharma like the new steel in a trade war, subjecting it to the same old protectionist tools.
Right.
But unlike steel or cars, where consumers maybe have options, they can delay a purchase, choose something cheaper. Medicine is non-negotiable.
Fundamentally different.
So if that patient backlash forces the government's hand, if they have to withdraw or drastically change this tariff before any new factories are even close to being online, what does that tell us? What does it signal about the real limits of economic nationalism when it slams headfirst into essential, basic human needs? What stands out most to you about that tension between sovereignty and immediate affordability?